Hi. Let's learn about current assets. The current assets account is a balance sheet line item listed under the Assets section. It accounts for all company-owned assets that can be converted to cash within 1 year. Examples of current assets include cash, cash equivalents, accounts receivable, stock inventory, marketable securities, prepaid liabilities, and other liquid assets. The current assets account is the first account listed in a company's balance sheet under the Assets section. It is important for investors because it shows a company's short-term liquidity. Depending on the nature of the business and the products it markets, current assets can vary widely. Current assets can include cash, cash equivalents, marketable securities, accounts receivable, inventory, prepaid liabilities, and other short-term investments. These assets are ranked by liquidity and can vary in each industry. Current assets are those that can be converted to cash within 1 year, while non-current assets cannot. Non-current assets include property, plants, buildings, facilities, equipment, and other illiquid investments. The total current assets formulation is a simple summation of all the assets that can be converted to cash within 1 year. It includes cash, cash equivalents, inventory, accounts receivable, marketable securities, prepaid expenses, and other liquid assets. For example, Walmart's total current assets for the 2021 fiscal year were $90 billion, while Microsoft's total current assets were $184.4 billion. This demonstrates the considerable difference in current assets between companies. The total current assets figure is crucial to company management and investors. It reflects the company's cash and liquidity position and helps management to make decisions about reallocating and liquidating assets. Creditors and investors use it to assess whether a business is capable of paying its obligations. Several financial ratios use current assets to measure a company's liquidity position, including the cash ratio and the current ratio. These ratios assess the company's ability to pay outstanding debts and cover liabilities and expenses without liquidating its fixed assets. Common examples of current assets include accounts receivable, inventory, marketable securities, prepaid expenses, and other liquid assets. However, there are also specific current asset accounts that are industry-specific. In summary, current assets are crucial for a company's short-term liquidity and ability to pay its short-term obligations. The assets considered current vary by industry, but generally include cash, cash equivalents, accounts receivable, inventory, and other liquid assets. Here are 3 key takeaways. 1. Current assets is an account listed on a balance sheet that shows the value of the assets owned by a company that can be converted to cash through liquidation, use, or sales within 1 year. 2. Current assets include cash, cash equivalents, accounts receivable, stock inventory, marketable securities, prepaid liabilities, and other liquid assets. 3. The current assets account is important because it demonstrates a company's short-term liquidity and ability to pay its short-term obligations. Hope this would help. Thanks for watching.